Bitcoin, a name that echoes through the corridors of digital transformation, has become synonymous with the concept of cryptocurrencies. Introduced in 2009 by an anonymous entity known as Satoshi Nakamoto, Bitcoin promised a new era of financial transactions. The allure of Bitcoin lies in its ability to provide a decentralized transaction platform, free from the control of any government or central bank. The currency uses a technology called blockchain, a term that has become just as popular, if not more. This technology allows Bitcoin to ensure security and anonymity for its users, which has been a significant factor in its adoption worldwide. As we move deeper into the digital age, understanding Bitcoin's mechanics, implications, and potential is becoming increasingly crucial. Bitcoin's rise to prominence is not just a testament to its technological prowess, but also reflects a growing distrust in traditional banking systems. The 2008 financial crisis, for instance, played a critical role in fostering interest in alternatives that offer more control and transparency to the individual. This backdrop sets the stage for an exploration into how Bitcoin works and why it matters in today's financial landscape. Blockchain is the bedrock upon which Bitcoin is built. It is a digital ledger that records all transactions made with Bitcoin, ensuring that each transaction is both secure and transparent. Every transaction is added to blocks, which are linked together in a chain, hence the name blockchain. This structure is maintained across multiple computers connected via a peer-to-peer network, making it nearly impossible to alter any information retrospectively. The decentralized nature of blockchain means that it does not require a central authority to oversee or validate transactions. This democratization of financial transactions is revolutionary. It not only reduces the potential for fraud, but also eliminates the need for costly intermediaries, such as banks, thereby lowering transaction fees dramatically. In practice, blockchain offers a transparent transaction process where each participant can verify the transactions independently. This transparency builds trust among users and increases security because altering any information on the blockchain would require the consensus of the majority in the network. This feature is what makes Bitcoin's blockchain a breakthrough in not only financial, but all sectors that rely on transparent record-keeping. Cryptography is fundamental to the operation of Bitcoin. It secures transactions, controls the creation of new units, and more importantly, ensures the integrity of the blockchain. At its core, cryptography uses complex mathematical algorithms to encrypt data, making it readable only by the sender and the recipient. This encryption process is vital in preventing unauthorized access and fraud. Bitcoin specifically employs a cryptographic technique known as a hash function, which converts data into a fixed-size string of characters. This is unique in that any alteration to the original data will result in a completely different hash. This property is essential for the security of the blockchain, as each block contains the hash of the preceding block, creating a secure link between them. Moreover, Bitcoin uses public key cryptography, where each user has a pair of cryptographic keys, a public key which is shared openly, and a private key which is kept secret. This method allows users to digitally sign their transactions, which are then verified by others in the network using the sender's public key. This dual key system reinforces the security framework of Bitcoin, ensuring that only the owner of the Bitcoins can spend them. Bitcoin mining is the process by which new Bitcoins are introduced into the system and transaction records are verified. Miners use powerful computers to solve complex mathematical problems that validate transactions. When these problems are solved, the miner is rewarded with new Bitcoins. This not only incentivizes miners, but also secures the network by validating its transactions and maintaining the ledger. The difficulty of these mathematical problems adjusts automatically depending on how many miners are competing at any time. This ensures that the rate at which new Bitcoins are created follows a predetermined schedule. This predictability is an essential feature of Bitcoin's economic model and one of its principal differences from traditional fiat currencies, which can be printed at will by governments. Mining also plays a crucial role in introducing new Bitcoins into circulation, a process that is capped at 21 million coins. This cap is intended to prevent inflation and mimic the finite quantity of precious resources like gold. As more bitcoins are mined and the rewards for mining decrease, the incentive will shift more towards transaction fees, ensuring the sustainability of the mining process. Section 5. The Ledger System and Transparency. The ledger system in Bitcoin is a public record of all transaction activities, which is both transparent and immutable. Once a transaction is recorded on the blockchain, it cannot be changed, effectively making it tamper-proof. This level of transparency is unprecedented in financial systems, where transactions can often be obscured and difficult to trace. This immutability is ensured through the consensus mechanisms used in blockchain technology. For a transaction to be added to the ledger, it must be verified by the majority of participants in the network. This process, known as proof of work, not only secures the network, but also ensures that all participants agree on the transaction record. Moreover, the transparency of the Bitcoin ledger means that while the identity of the parties remains protected, the transactions themselves are open to everyone. This characteristic can help in various scenarios, from reducing corruption in financial systems to providing clear traceability in supply chains. The potential applications of such a transparent ledger system are vast and varied. Section 6. Bitcoin and Global Finance. Bitcoin's impact on global finance is multifaceted, offering both opportunities and challenges. As a decentralized and global currency, Bitcoin allows for seamless international transactions without the fees or time delays associated with traditional banking. This has made it particularly attractive for remittances and transactions, where traditional financial systems are inefficient or unavailable. Moreover, Bitcoin presents an alternative to unstable fiat currencies, particularly in countries experiencing economic turmoil. In such scenarios, Bitcoin can offer a more stable store of value compared to local currencies subject to hyperinflation. This aspect has been crucial in increasing Bitcoin's adoption in various parts of the world. However, the integration of Bitcoin into global finance has not been without its challenges. Its volatility, for instance, poses risks for both individual investors and the broader financial system. Additionally, regulatory concerns and the potential for misuse have led to calls for tighter controls on cryptocurrency transactions. These issues highlight the complex relationship between Bitcoin and traditional financial systems. Beyond its use as a currency, Bitcoin has spurred a variety of applications in different sectors. One significant area is in digital contracts, also known as smart contracts. These are self-executing contracts where the terms are directly written into code. Bitcoin's blockchain can be used to create and enforce these contracts, which are transparent and irreversible. Another application is in the area of digital identity verification. With Bitcoin's technology, individuals can create a digital identity that is secure and immutable. This can be particularly useful in reducing identity theft and fraud in online transactions, providing a more reliable method of verification than traditional forms. Furthermore, Bitcoin is being used in philanthropy and crowdfunding. Its ability to send and receive funds anywhere in the world quickly and cheaply makes it an excellent tool for raising money for causes and projects, especially in places where traditional banking is inaccessible. This has opened up new avenues for funding and has democratized access to capital. Despite its groundbreaking technology and growing adoption, Bitcoin faces significant challenges. Scalability is one of the major issues, as the current technology underlying Bitcoin allows for only a limited number of transactions per second. This limitation can lead to delays and higher transaction fees, which detract from its utility as a daily transaction medium. Regulatory challenges also pose a significant hurdle. Governments and financial institutions worldwide are grappling with how to integrate Bitcoin within existing financial regulations and frameworks. The anonymous nature of Bitcoin transactions complicates efforts to combat money laundering and other illegal activities. Moreover, the environmental impact of Bitcoin mining has become a point of controversy. The immense amount of energy required to power the computers that perform the mining has led to concerns about its sustainability. As the dialogue around environmental impact grows louder, the pressure increases on the Bitcoin community to find more energy-efficient solutions. The future of Bitcoin and other cryptocurrencies looks both promising and fraught with challenges. As the technology matures, we can expect more refined solutions to issues like scalability and energy consumption. Innovations such as the Lightning Network promise faster transaction speeds and lower costs. potentially boosting Bitcoin's utility as a daily transaction medium. Moreover, the increasing interest from institutional investors and the integration of blockchain technology into various sectors suggest that cryptocurrencies will continue to play a significant role in the financial landscape. As traditional financial institutions begin to adopt these technologies, we could see a more seamless integration of cryptocurrencies with conventional banking. However, the path forward is not entirely clear. Regulatory developments will significantly shape the industry's landscape, and the broader acceptance of cryptocurrencies will depend on their ability to address current shortcomings. The journey of Bitcoin and its peers is still very much in progress, with many chapters yet to be written. In conclusion, Bitcoin is not just a currency, but a revolutionary technology that has the potential to reshape the financial landscape. Its impact extends beyond mere transactions, touching areas like contracts, supply chains, and even governance. As we continue to navigate its complexities and potentials, the importance of understanding and adapting to this technology becomes more apparent. The journey of Bitcoin is a testament to the power of innovation and the quest for financial autonomy. While there are challenges ahead, the continued evolution of Bitcoin and blockchain technology holds the promise of more transparent, efficient, and inclusive financial systems. As we look to the future, it is clear that the influence of Bitcoin and cryptocurrencies will only grow, potentially transforming not just how we transact, but how we think about money itself.